Let's talk about how you can hack your retirement portfolio to help protect you during the most crucial period of your retirement. By the end of this video, you're going to know what the most important years for your retirement are. You're going to know what the biggest risks that you're going to face in retirement and a strategy that will help you navigate that risk. Welcome back to the Think Retirement channel, where we help you build a confident and secure retirement. Today, we're diving into something that a lot of people tend to overlook, but it's extremely important if you want a smooth retirement without any unpleasant surprises. And we're talking about something called the portfolio size effect and what we like to call the retirement red zone. So these concepts are key to understanding how your investments grow and how to protect yourself as you approach and enter retirement. Saving for retirement is often described as a long-term game where you gradually build wealth through regular contributions and the power of compounding growth. We've always talked about how important it is to start saving as early as possible to set yourself up for long-term success. But here's something that most people don't realize. In the early years, how much you save is actually more important than how much you earn on those investments. Now, why is that? It's because in those early stages, your portfolio just isn't large enough for growth to have a major impact. What really matters in those first 5 to 10 years is that you're contributing regularly. The growth on that small portfolio just doesn't add much yet. For example, let's say that you're contributing $300 a month to your retirement account. By the end of the first year, your account balance is going to be around $3,600. Now, even if you get a great return that first year, let's say 10%, that's just an additional $360 of growth. So the vast majority of your account growth is still coming from what you put in, not from market returns. But as you continue saving over 10, 20, or 30 years, something really interesting starts to happen. After about 10 years, the growth of your investments begins to match the contributions you're making. And suddenly, your portfolio is pulling its own weight. By 20 years, the majority of your balance comes from growth from your investment returns. And after 30 years, almost 90% of the increase in your portfolio is driven by growth, not your direct contributions. This is what we call the portfolio size effect. Sounds great, right? Well, it is, but there's also a dark side to it. The same portfolio size effect that boosts your returns as your account grows can also magnify your losses. And that's where the danger of the retirement red zone comes in. So the retirement red zone refers to the 10 years leading up to retirement and the first 10 years into your retirement. This is when your portfolio is at its largest. It's the product of decades of saving and investing, which also means that it's at its most vulnerable. Any major market downturn during this period can have catastrophic consequences to your retirement plan. Now, let me explain why this is so important. Imagine that you've spent 30 years building up your portfolio to $1 million. At a 4% withdrawal rate, you're expecting to live off about $40,000 a year from your savings alone. But what if right before you retire, the market drops 20%? And suddenly, that $1 million has now shrunk to $800,000. That's a loss equivalent of 5 years worth of retirement spending. That's the danger of the retirement red zone. In the early years of retirement, you're most at risk because your portfolio is the largest it will ever be. Any losses during this time are much harder to recover from because you're starting to withdraw from the account. If the portfolio shrinks too much, it may never recover to sustain your standard of living. This is known as sequence of return risk. The risk that you experience poor investment returns at the worst possible time. And it's all magnified by the portfolio size effect because those earlier losses hit a much larger portfolio, making the dollar amount of those losses much more significant. So what can you do to protect yourself from the portfolio size effect and avoid a retirement disaster in the red zone? One of the most effective strategies is to adjust your allocation as you approach retirement. This is where the concept of a V-shaped asset allocation comes into play. Rather than staying aggressively invested as you get closer to retirement, the idea is to gradually reduce your risk by shifting a portion of your portfolio into bonds and other stable investments. This helps protect the wealth that you've built up. So if the market takes a hit, your portfolio doesn't. Let's break this down a little more. In the early savings years, when your portfolio is small, it makes sense to be aggressive in stocks. The growth potential is there, and you're not risking much in terms of dollars because the portfolio is still small. But as you approach the retirement red zone, you should begin to gradually reduce your risk by increasing your allocation to bonds. So the idea here is to build what we call a bond tent. This is an upside down V-shaped of increasing bond exposure as your portfolio grows in the years leading up to retirement. This helps protect your portfolio from volatility when it's at its largest and most vulnerable. Now, a lot of target date funds do this by gradually getting more conservative, but the way those are managed only goes one direction, and that is more conservative. And what we're talking about is a V-shaped asset allocation. And what makes a V-shape? Well, the other side of the V. So once you're in the early years of retirement, you can gradually start reducing your bond allocation and getting more aggressive again. And why? Because after those first 10 years of retirement, the size of your portfolio has likely reduced a bit as you've been withdrawing from it. So the potential impact of a market downturn isn't as severe as it was the first decade. This glide path of being more conservative in the early years of retirement and then more aggressive later on is counterintuitive for some people, especially since conventional wisdom says that you should keep reducing your risk as you age. But research has actually shown that being a little more conservative in the immediate years before and after retirement, and then gradually increasing risk later on, can actually provide better outcomes for retirees. In fact, research done by Wade Pfau and other experts have shown that this strategy can help manage sequential return risk while allowing your portfolio to grow and support you through the later years of your retirement. So what does this all mean for you? Well, if you're in the final decade before retirement, or if you've recently retired, it's time to start thinking about your portfolio differently. You've built up a nest egg and now it's time to protect it. The portfolio size effect can be a double-edged sword. It boosts your growth when the market's up, but it also magnifies your losses when the market goes down. And I would argue right now, the market is near all-time highs. It is the best time to make any changes to your portfolio. So many times throughout my career, I've seen people always want to make changes when it's too late and the market's already gone down, and that's when they want to start taking less risk. The retirement red zone is a critical time where small missteps can have big consequences. A well thought out asset allocation can help you weather any market downturn without putting your retirement at risk. At the end of the day, retirement planning is all about balance. It's about managing risk while still allowing your portfolio to grow. And understanding the portfolio size effect and the retirement red zone is a huge part of that. So take a look at your current strategy and ask yourself, are you prepared for the risks that come with a larger portfolio? If you found this video useful, make sure you hit that subscribe button, and also drop your strategies in the comments below. I'd love to see what you're doing as you approach retirement. And remember, retirement is a journey. Let's make sure that you're well prepared for every step of the way.